folks, we had another great week, lots of green on Friday afternoon. And Derek, since this rally has started, we've been up significantly, and all I would say is, who'da thunk?
Right, we're up about 12% from the lows we made just a month ago. I will point out that fear and greed index, which was below 20 at that time, is now approaching the August highs at 61. So clearly a lot of improvement in terms of sentiment and price appreciation. And that's despite the fact that we still expect the Fed to hike the Fed funds rate by 75 basis points next week.
Yeah, we did see a PCE report on Friday morning, and PCE is personal consumption expenditures, and it's really the favorite number of the Fed. They look at that, and that number came in at 6.1% on an annualized basis. And, they want to get that number down. Of course, the core rate up 5.1%. That's the third straight raise in the core rate. So it's not really cooling, which, as you said, Derek, really means that we're going to have a 75 basis point hike here in the first week of November, right before the election, and likely one after that. So we'll have to watch what they say after the report. But, of course, it is not cooling because a big part of what's continues to go up is the wage reports, and we saw a wage report that came out yesterday morning as well, which showed that earnings continue to go up.
Yeah, they do, but they are going up at a slower pace, which is something that Chairman Powell mentioned that he was going to track, because one of the things they're trying to do is curb demand, which is leading to inflation. And as you see wage growth start to dissipate a little bit and quit rates start to dissipate a little bit, that will give the Fed the opportunity to perhaps raise rates at a much slower pace going forward, which is something we also expect to hear about next week as well.
And so we see the PCE report going up. We saw U.S. wages went up as well. They went up 0.4 in personal income, but of course spending went up 0.6, which leads me to the idea that we continue to grow. The GDP report, which came out at 2.6%, we found it very interesting because a big chunk of that 2.6 came from a falling trade deficit.
Right. We had substantial exports overseas. So that's what led to most of the increase. When you actually look at domestic purchasers, though, which is really a better measure of underlying economic demand, it only increased at a 0.1% rate. So perversely, while we did see a positive number this time versus two negative reports in the past two quarters, the economy actually is a little bit softer than it was then when people were concerned that we were in a recession.
Right. As we go into 2023, all signs are pointing to a dramatic slowdown in 2023. But of course, folks, the markets look ahead 2, 3, 4 quarters and sometimes years out. And that's why we're watching these earnings reports that are starting to come out. We saw some blowout reports from energy companies and not so good out of tech.
Right. Most of the FANG stocks have actually missed expectations. Amazon lowered guidance for the fourth quarter, a very poor result there. We heard horrible results from Meta, formerly known as Facebook. Apple, however, did beat on earnings and revenues. And also, their iPhone sales were a little bit light, but they attributed that to supply chain constraints. So Apple, the biggest market cap company in the NASDAQ and the S&P 500, was up sharply on Friday.
And you did call everyone's attention to that over the last couple of weeks, saying that there is an overweight to those tech companies in the S&P 500. So if there's a correction, it could pull down the index while the underlying performance, other stocks are doing better.
Right. We've noted that equal weighted indexes are vastly outperforming market cap weighted index. We've also talked about how, in our portfolios, we've been tilted towards smaller cap stocks because we believe, A, they don't get affected by the dollar strength trying to sell things overseas, and B, they're purer plays and more nimble. So to the degree that you're buying small cap companies that make money, it makes a lot of sense to us that they should continue to outperform the S&P 500.